The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A push forward on tariffs, a pushback on AI, and a massive haircut potentially for the year's biggest IPO. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. A mixed day. I'm surprised we're not seeing that follow through selling from yesterday.
Yeah, well, it depends on what sector you're looking at, though, right?
This is a good point.
Yeah.
Auto's not doing so great. Chips not doing so great. S&P, though, just down by 0.2%. Tech, as I mentioned, obviously getting hit the hardest. I was looking at the SOX index, so the Philadelphia Semiconductor Index. You got NVIDIA heading lower. You have AMD heading lower. Marvell, Taiwan Semi, all of that leading the sector lower. A teeny bit, Romaine, of a bid into some safe haven like the 2-year yield. And gold, though, another record high, just continues to crush and outperform.
Absolutely. But tariffs once again stealing the show. We should point out we are expecting to hear from the Prime Minister of Canada, Mark Carney, at any moment right now. Those auto tariffs, so keep in mind, don't actually take effect until a week from today, already having reverberations. General Motors falling the most since January. Car electronics company Lear sliding the most since August. You have seat maker Adient, that's down the most since 2022. Meanwhile, AutoNation, TrueCar, other retail platforms that are exposed to new car sales, they're all plunging. But sellers of used cars like CarMax, they're rallying. That even includes rental company Hertz, which of course sits on a huge inventory of used vehicles that are now likely to appreciate in value. And as the broader automotive space tries to come to some sort of reckoning with these new tariffs, the broader AI space is still reckoning with evidence of a tech spending slowdown. The Global X Artificial Intelligence ETF testing its 200-day moving average. Chipmaker AMD actually got a downgrade to hold earlier at Jefferies. Dell, which has been selling a lot of servers for those data center build-outs, that's down 47% from its record high in Vertiv, the maker of data center power systems that surged 30+% to start the year. Well, it's erased all of those gains as of today. The ripple effects now affecting the IPO market as well. CoreWeave, this is the crypto miner turned cloud computing provider turned AI data center builder. It was teed up to be the biggest public listing of the year, but Bloomberg now reporting that the size of the IPO drastically scaled back, at least 40% of that initial valuation, as investors now and their appetite for all things AI tempers just a bit, Alex.
I love that setup because are tariffs actually clouding the fact that that AI investment thesis is rolling over? And this chart may help explain it a little bit. It's a normalized chart ever since the market started to roll over. The equal weighted index, which is the blue, and then the white is the S&P, and then the yellow is the NASDAQ 100. And you can see on a normalized basis, it's still the equal weighted index that's continued to outperform. They're all down, but equal weighted is higher. So it's really about that big tech as the AI trade starts to really shake out a little bit, Romaine, and how much more downside could there be?
Let's go back to tariffs, though. Alex, yesterday we heard from the President of the United States on those tariffs. Now we hear from the Canadian Prime Minister, Mark Carney.
Dedicated Canadians that industry supports across our country. Now, the President of the United States is trying to fundamentally restructure his economy. It means our economy, and it means the global economy as well. And I understand and respect his goal to support American workers, but I disagree with him that this is how to help them. With time, it will become apparent that these actions will end up hurting American workers and American consumers. I reject any attempts to weaken Canada, to wear us down, to break us so that America can own us. That will never happen. And our response to these latest tariffs is to fight, is to protect, and to build. We will fight the U.S. tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada. We will protect our workers and our industries during this difficult period. But above all, we will build a new Canadian economy. We will build Canada strong. Se battre pour nos travailleurs, protéger notre économie et nos concitoyens, bâtir un Canada fort.
And right now, there on your screen, you're watching and listening to Mark Carney, the new Prime Minister of Canada, responding to the latest tariffs that have now been unveiled by the United States just overnight here. They plan to take effect in about a week, primarily affecting the automotive industry, but a major industry, at least in terms of cross-border trade, has a huge impact on Canada. Mark Carney says that their response to these tariffs, they're going to fight, protect, and build. He said there will be retaliatory tariffs that, in his words, will have a maximum impact on the United States and a minimum impact on Canada. You can go to your Bloomberg terminal, type in Live Go to continue listening to those comments. And, of course, any major news that comes out of that, we'll bring it to you as soon as we get it. Of course, the tariff discussion has been a main driver of a lot of the price action that we've seen in the market, and that includes today as we kick you off to the close with Scott Chronert. He's the U.S. equity strategist and global head of ETF research with Citi. All right, Scott, we have to start off with tariffs, of course, because that is the elephant in the room. Everyone's, I think, is trying to parse not so much whether there's going to be an effect on markets and, for that matter, the economy, but how long the effect is going to be. Do you look at this rollout of tariffs, what we learned yesterday and maybe what we learned on April 2nd, as something that this market is going to have to deal with for more than just a few weeks or months, but maybe possibly years?
Romaine, it's a very good question. The way we've been talking about it is that the tariff discussion really is about magnitude of tariffs and then duration of tariffs. We're starting to get more visibility now on the magnitude, obviously, with the news most recently on autos and so forth. The duration becomes an ongoing question, right? And we've been trying to be focused on the differentiation between tariffs imposed for negotiating purposes versus tariffs that are part of a broader revenue-raising campaign by the administration to offset other elements of their plan, including the extension of TCJA. So my point here being is that we're suspecting that we're going to get an initial salvo of negative revisions to the S&P 500 companies as we go into the Q1 reporting period. This will, to a certain degree, begin to reset expectations, but it's pretty premature to say that we're going to be at the end of this. We think this is going to be an ongoing back and forth for months to come. I
am curious, too. I mean, we've spoken with so many strategists, economists, and other folks on Wall Street who basically said right now it's so difficult to try to model anything right now because we don't know. We don't know what tariffs will be there, whether something will be negotiated and it'll be rolled back. What do you expect to actually hear from the companies themselves? Because I assume they don't have any more clarity to be able to provide a forecast, or at least a forecast that they can comfortably stand behind.
Right. Well, I think we have to assume that companies aren't idly standing by. They're probably, doing their own versions of what-if analyses on this and talking about responses they can make with internal reorganizations and so forth. But that said, I do think your point is well taken. The sell-side community has been in a difficult position. We try to do it from an index level perspective, bring it down to industry group, but we know we're lacking precision on this. The individual company and sector analysts are going to be, I think, taking cues from company managements as we go into the reporting period. That's going to be the next opportunity. And here I would expect that managements will begin to provide some context around their thinking about tariffs, where they're impacted, and what their potential responses are. This gets us going. Okay, but to your point, even to the degree that C-suites don't have perfect visibility on this, we have to expect that it's going to be an ongoing dialogue in the Q1 reporting period, probably out into Q2 and potentially out further into the year.
Scott, what's interesting, though, is I was taking a look at the normalized chart over the last 6 weeks of that equal weighted index versus the S&P and the NASDAQ 100. And the equal weighted index is holding up okay. So that tells me this is more of a tech story, no?
There's a lot going on here, Alex. You're spot on with that. As you were describing the charts earlier, I was thinking, well, the work we've done recently essentially makes the following point. The S&P from its Feb 19 peak to its lows 2 weeks ago was down roughly 10%. But your Mag 7 component, this mega cap growth part of the market, is down, generally speaking, 20% or more from 52-week highs. Mm-hmm. So what's happened here is that the unwinding of the mega cap growth complex and part of the market really has had the dominant influence on the aggregate index data. When you look at the other sectors away from tech, consumer discretionary, and communication services, it's a much different balancing act. Energy having a good quarter, healthcare doing fine, financials doing fine. Fortunately, we're overweight those three. Mm-hmm. With your defensive areas also, generally speaking, showing signs of stability here. So the sector picture, it helps to describe what's happening more broadly with that equal weight component. We've been looking for a broadening dynamic to unfold as we go through this year. That's happening, but maybe per a little bit different lens with this mega cap growth cohort really seeing the bigger valuation correction.
Right, and so it begs the question for me, is the tariff discussion obscuring and taking up the airtime when it's the unraveling of the AI trade that we're seeing in legitimate form is the actual problem here?
I think you're right to a certain degree. So the way we're starting to go at it, again, we're trying to assess all of this at the index level, but let's face it, the tariff situation is really going to play out at the company specific, if not industry group level, which is what you're seeing in the autos today. What we're going to find out pretty quickly, though, as companies provide a little bit more visibility in how they're thinking about tariffs, we're going to find out what's being priced in and what isn't. And we have to respect that the market, even though we've lacked granularity, has been getting ahead of this and going to those companies and those parts of the market that are potentially most exposed. So what you're looking for here is a glass half full versus glass half empty circumstance as we go into the Q1 reporting period, namely, will more granularity on tariffs prove to be a clearing event? Okay, great, we price that into the fundamentals and now we can look ahead. Or will it be an ongoing source of uncertainty? The broadening part of the play within the markets here persists, but here's what we would point out, and that is that as a function of the mega cap growth part correcting more aggressively than the rest of the market, it's actually less expensive now versus its own history than the rest of the market. So what we're teeing up for as we go into this reporting period and into Q2 in general is that we're going to see a resumption of this growth as defensive play come into the price action within the S&P as we weigh the impact of tariffs along with other pressures on aggregate consumption and begin to test economic resilience along those lines.
All right, Scott, I have to leave it there. Scott, always a pleasure. Scott Chronert, U.S. Equity Strategist and Global Head of ETF Research over at Citi. And just a reminder here, Mark Carney, the Prime Minister of Canada, is still speaking. He has not rolled out any specific details, but as to Scott's points about the uncertainty around that April 2nd deadline, we also have to remind ourselves a lot of uncertainty about the response that we get from the other nations, including Canada, Mexico, and Europe. A lot more coming up on this program, including a continued conversation about the uncertainty surrounding policies coming out of Washington and how it could impact the credit market. David Forgash is Managing Director and Portfolio Manager at Pimco. He's joining the program in just a second.
All right, speaking of President Trump, the United States president working his way back into the real estate game, we're going to discuss the broader impact of his administration's policies to the commercial and residential market with Don Peebles, Chairman, CEO, and founder of the Peebles Corporation.
And we continue to keep an eye on what's going on in the automotive space and, of course, what is actually going to happen with that response from Canada. Dave Mackey's going to be joining us. He's the CEO of Canada's largest bank, RBC. He'll be joining us later, right here on The Close on Bloomberg.
That expected M&A boom that was driven by President Trump's return hasn't quite materialized in the same way that many had been expecting, in particular when it comes to Wall Street. A lot of buyers and sellers in a wait-and-see mode due to policy uncertainty. Also, the bid-ask spread just not coming in. As a result, M&A activity, private equity deals, IPOs are all being affected. Joining us now is David Forgash, Managing Director and Portfolio Manager over at Pimco. He's also the head of Pimco's leveraged finance business, overseeing high-yield CLOs and loan portfolios. All right, David, that's my pitch to you.
Thanks for having me.
You're on the inside. How do you see the M&A market in relation to leveraged finance and high yield and CLOs, et cetera?
Well, first of all, M&A is a big determinant of how they get their funding is through the leveraged finance market. So we are seeing more deals come through. A lot of these are further out, but with the new administration and some policy changes that are expected, you're already starting to see the M&A pipeline pick up. And that is actually having an effect on how investing is for the high yield and leveraged loan market.
I have no doubt the demand is there,
Yeah.
but how does the uncertainty affect the deals? Like, I can imagine with these headlines and the volatility, that's going to postpone things.
Yes, it does postpone some of them, but it also, and any time that there is uncertainty, it obviously brings the volatility of the market, which we're seeing right now. And it also brings out better pricing, to be honest, when it comes to investing in high yield deals. So it does bring both, but there's a lot of opportunity now that if you think about the past 18 months, where the market was pretty flat as far as volatility, and there weren't a lot of M&A deals. Now you're bringing this new area to the market, this new issuance that's very helpful.
Is that sort of a function, though, also of the demand for greater return or greater yield on that side? Because, I mean, you're specifically referring to a lot of high yield deals. And I understand why people would find that attractive, particularly given what asset prices look like in other corners of the market.
Yeah, well, it is.
Yeah.
And I think it is still very attractive. I mean, the high yield market, if you think about the volatility that's taken place so far this year, the high yield market has actually behaved quite healthy. The spreads are marginally wider, but returns are almost near 2%, which is a lot different than you're seeing in equities.
Yeah.
So it's got lower volatility, but it's more of equity-like returns if you think about high yield. And the high yield market itself is different from what it was even 5 years ago, with lower leverage within these companies.
In terms of investor demand, are you
Yeah.
seeing material differences in their appetite for high yield loans or leveraged loans relative to, say, junk bonds?
So high yield and high yield bonds and leveraged loans, we're seeing increased demand for both.
Okay.
And it is because the levels are very attractive. You're getting 7.5%, 7.75% yield, and at least in the case of high yield markets, a very low default rate over the last 12 months, close to about 1%.
Yeah. And you think those conditions are going to stay through the rest of the year, more or less?
I think the volatility is picking up. We're seeing that pick up.
Yeah.
So the expectation would be that you're going to likely see defaults pick up around the edges.
Yeah.
But generally speaking, the asset class, like I was saying before, is much different than it was several years ago, where it's a higher quality in general.
When Germany unleashed all that spending and we saw rotation into European equities, there was a narrative that perhaps we're going to see money come out of the U.S. and into the credit market in Europe and into the bond market in Europe. Did you see any signs of that? Are you seeing that at all?
It's early days, but it is very positive when you think about Europe coming in and reigniting the economy and going back to more manufacturing. I mean, that does provide areas for investment. So we invest globally when it comes to high yield leveraged loans and credit in general. So for us, when we're seeing opportunities there where we hadn't seen them prior.
So to that point, it does feel like we're looking at sort of a nationalist domestic policy for many countries, right?
Yeah.
We're hearing that from Mark Carney right now. We have to fundamentally reimagine the Canadian economy. Does that mean more regional opportunities like for you guys? Because to do that, there's going to be more debt. There's going to maybe have to be consolidation. You're going to have to raise money to build a factory somewhere.
Yes.
Like, how are you seeing that unfold?
Well, it's unfolding in other countries, and it'll unfold in our country as well here. I mean, you're seeing areas of investment where you hadn't seen previously. They're bringing a lot of investment, or at least saying a lot of investment, back to parts of the U.S., as well as onshoring in other countries as well. So it certainly moves around the ability for companies to invest. But when you do have times like this where there is uncertainty, companies are reluctant to put forward a lot of investment. And that is what you're seeing right now. You're definitely seeing a pause when it comes to investing for some of these companies, whether it be CapEx or otherwise.
How much do interest rates matter right now, or maybe the potential for changes in interest rates matter?
Well, when you think about high yield bonds, it certainly matters because you're borrowing at a higher level. These companies do have higher leverage, so their borrowings are higher. So it does certainly affect it. And the preference would be for these companies to have lower borrowing costs. But in general, when we're keeping at rates where they are right now, it's still an attractive time for companies to borrow when you're having a growth environment. And we're still in a growth environment as far as GDP.
Yeah, we certainly saw that, of course, backward-looking data, but of course,
Yes.
the updated GDP numbers we got today, and that'll probably be ratified when we get the 1Q numbers. Great conversation, by the way.
Great.
Absolutely
come
great to have you. David Forgash, Managing Director, Portfolio Manager, and Head of the Leveraged Finance Business over at Pimco, as we continue to march towards those closing bells. A closer look at some of the big movers on the day, and that includes AMD. The shares moving lower on the back of a new sell-side note that the company might not be able to keep up with its main AI competitor. That's our stock of the hour, and it's up next, right here on The Close. This is Bloomberg. Time now for our stock of the hour. AMD shares down about 3%, second straight day of declines. A new note out from Jefferies today, raising concerns that the chip maker is continuing to fall behind NVIDIA's pacing in the AI space. Jess Metten, senior equities reporter here at Bloomberg, joins us right now. They've been behind for a while. Did something new happen?
Well, well, particularly for today, it's the downgrade with Jefferies. So Blaine Curtis is the analyst there that did that, and they were pointing out, not surprisingly, that they're falling behind. But when you look at more of the scope here, and when you're thinking about GP units, and those are tied to that, NVIDIA, I mean, it's still close to about 90% dominant of the market share right now. But when you're looking at AMD, it's only about 10% of that. And then Intel, of course, is only about 1%. So, of course, we remember when Intel got kicked out of the down, replaced with NVIDIA back in November. But specifically with AMD, if you look at the ANR function, there's actually only one sell so far on this. But based on the price target cut by Jefferies, they went from $135 to $120. And so that would be amongst some of the lowest on Wall Street sell-side targets right now for this particular company.
Yeah. And also, it was interesting to note, they also said that Intel could be a competitor too, and I haven't, or like they're ramping up. I haven't heard that statement in a very long time. Just how far behind do analysts think that AMD is right now? So
that's the thing, because Jefferies thinks that there's still more room to go. And if you look at the average target for this company in the ANR function, it's around $145. And that Blaine is actually arguing that he still thinks that that sell-side consensus estimate, where that midpoint range is, actually needs to come down even further from here. And a year ago, that was the last time its stock hit an all-time high. It was trading over $200 then. Now it's trading a little bit above $100.
I do want to, before we let you go, ask you about what is the broader AI sentiment right now? Because I know it's easy to pick on AMD because they were kind of laggards. And we are seeing NVIDIA down for a third straight day, though obviously valuation's still enormous compared to where it was a few years ago. Are people really over that? Are we making too much of it? Or is this really people just kind of saying we're moving on because maybe we did kind of bid these things up too fast?
Well, we can look to later tonight with CoreWeave, because that's the first company that's supposed to go public that's tied to the big AI story here. Bailey Lipschultz and Ryan Gold have been reporting on this. And so basically the valuation, I mean, you continue to see this dropping. It was close to around $4 billion, then it was $3 billion, now it's around $1.5 billion. And so when we get more details on this, that's just telling you a lot of these hedge funds tied to it and long onlys, they're starting to not have as much conviction on that type of, especially we were just talking about yesterday with Microsoft and data centers.
Well, that's the thing, because CoreWeave helps build out those data.
Yes,
and I saw Microsoft is like their biggest customer.
And they have close ties to NVIDIA and were the first ones.
Chips,
exactly. So that's something that you're starting to see here too. And even more broadly in the IPO space, about 8 of the 10 this year that have listed have been underperforming.
Because it's really expensive to build out LLMs, right? So you want to rent the space, but they provide the space, and that costs a lot of money. Jess, thanks a lot. Really appreciate it. Looking forward to that pricing. Jess Metten joining us.
Don't go anywhere.
From Bloomberg. No, you can go. Don't worry. We'll get you back. All right, coming up, we're going to talk to Don Peebles, the CEO, chairman, and founder of the Peebles Corporation. His outlook for real estate, given all the uncertainty in the market, particularly when it comes to real estate in D.C. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. I'm looking at an S&P that is trying to get into positive territory here, really undecided and wishy-washy all throughout the day, despite that heavy selling we saw yesterday.
And it gets to this idea, too. I mean, you were bringing this up earlier in the show. I mean, the sell-off and some of the pain we've seen in this market, is it directly about tariffs in the economy, or is it more about that tech and AI trade that got a little bit too extended, or is it kind of a, I don't know, a little bit of a gumbo of it all?
Or is it a mishmash, right? Like, you clearly see auto stocks are still down, and that's definitely tariff-related. But then the AI stocks and the chip stocks, that's in some ways not tariff-related. So maybe it's a both. It's a twofer.
Yeah, one thing that's undeniable is that what's going on in Washington is certainly having a huge impact, at least in the way people feel about the markets and the economy.
Oh, yeah. Just look at that VIX, sort of a new range there. Chaos was what one person used to describe to me on radio, and the chaos in D.C. filtering into the chaos in the market. Joining us now to discuss is Don Peebles, chairman, CEO, and founder of the Peebles Corporation, one of the country's most actively privately held real estate investment and development companies. He was also a member of national finance committees for several Democratic presidents. Don, it's great to get your perspective. Thank you very much. Part of this quote-unquote chaos that we're seeing is the move from a fiscally funded-led economy to a privately funded held economy. Do you think that that can be possible?
Well, I think that we're going to see some great steps towards that. You know, Washington, D.C. is set in its ways, and to change it and change directions requires aggressive, almost chaotic efforts to do it. And that's why the bureaucracies continue to grow, because there hasn't been a president that has been as disruptive as, say, Donald Trump.
Right. So if we're going to try and transition, if it is possible, chaos is going to reign for a little bit. Does that create some dislocations for you as an investor?
Yeah, I think it creates dislocations with some great opportunities as well. Fortunately, we have one government leased building in our portfolio. It's in Washington, D.C., of course. But ultimately, it will create a recalibration. In fact, of Washington, D.C.'s economy overall, it's been heavily dependent on the federal government's presence. In fact, it has stymied any kind of creativity by the governmental leaders locally and the marketplace there. They just heavily rely, on government presence, as opposed to, say, what Mike Bloomberg did in New York, for example, which was to create a tech center and make New York City a tech hub by diversifying its economy. DC hasn't been able to do that. I think that this significant reduction in federal workforce and the high vacancies that DC is going to be looking at in terms of office space in the DC metro area will compel it to change. And that's going to have a devastating impact on the market short term. But overall, I think we'll see some of the major issues that DC and other parts of the country are confronting, such as affordable housing.
Who do you think, though, is going to lead that, Don, lead that effort? I mean, usually you need somebody there sort of being the figurehead, or at least, the drum beater, for lack of a better phrase.
Well, I think the private sector is going to need to do it. D.C. is where I founded my company. It's my hometown. My son's a third-generation Washingtonian, so I love Washington, D.C., and while I don't live there, we certainly intend to make significant investments. I started an investment banking firm, a asset management firm with Wall Street veterans called Donahue Douglas. And we are focusing on a office conversion fund right now, where we're going to raise $1.5 billion, and we're about 2/3 of the way there. And one of our key markets is going to be Washington, D.C. I think Washington, D.C. has the opportunity to reinvent itself. And frankly, as much as there's a lot of distrust between the local government and this president, I think the one thing that President Trump does want to see is Washington, D.C. reinvent itself. And so the city, if they look at it differently, could have a true partner in the White House.
Well, then I am curious, particularly with some of the real estate issues that the city was already going through even before this administration came to power. Of course, all of these GSA-owned buildings that, at least if you believe what Trump says, will probably be on the market sometime soon. I assume this is putting downward pressure on prices. And I'm wondering if you and what you're doing there over at Donahue Douglas, are you actively now in that market? Have you found something to buy? Do you have your eye on something right now?
We've looked at several things. I mean, we're committed to the market. For example, our strategy is to commit to the markets that we're in and not just do one-off deals. And so we're committed to 8 markets. And Washington, D.C. is number 1 on the list. And we are looking, kicking the tires on assets right now. I think there's a opportunity here to buy at prices that we haven't seen since the early 90s during the S&L and banking crises, where 1,000 banks and S&Ls were closed by the federal government. So I think there's going to be great opportunity there.
Have you actually spoken with anyone high level in the Trump administration specifically about the federal and GSA properties?
Well, I've talked to the several people in the Trump administration and previously to the president about how the government does need to downsize it. I mean, how can you have a user that consumes 100 million square feet in the metro area, about 80 million in exact numbers? How do you have them occupying 20 to 25% on the best day and keep paying for it? I don't think, though, that the government will be having massive quick sales on government-owned buildings. I think that what's going to happen is that they're going to start terminating more leases. They're already starting it right now. But what people don't understand is while these GSA leases could run for 15 or 20 years, they are all subject to annual appropriations, because no president can obligate the government to a lease longer than 20 years, but it's got to be subject to annual appropriations because they can only spend money that's been appropriated. So what you're going to see is significant increases in cancellations. And that's going to have a different impact because, of course, it's going to lead to more defaults. And that's going to put some pressure on the local and regional banks in the marketplace.
Interesting. Don, does that mean, so if those are the opportunities, is it all going to be conversions, or like what do you envision for the properties you're looking at?
Well, I think conversions are going to be key, for example, because right now in the U.S., for example, there's about 7 million units short for affordable housing. And no surprise, D.C. is one of the top markets. New York is number one, and L.A. is number two, and Miami is number three. And you go down the list, but D.C. is in the top 10. So, and yet the market is only producing 78,000 affordable housing units a year. So that creates a tremendous opportunity there. And then we're short about 5 million units overall in terms of market rate housing. And we're not producing more than about 1.4 million, which is barely per year, which is barely meeting existing demand. And so what happens here is that there's this big shortage. And so we think that there's a tremendous opportunity to do that. And also, not all office buildings are created equally. Not all office buildings are ripe for conversions. Many are going to need to be demolished. Mm-hmm. Others can still be competitive as office space. And I think we're going to see more people come back to work. We're going to see other businesses come in and take advantage of some of these lower price rents. And you're going to see more activity on the office leasing side, but the strongest are going to be the ones that survive, the ones with the best amenities, the ones with the best locations and the higher quality buildings. They'll prosper. And so you'll have a healthier office market once you get through this.
Don, I do have to ask you about economic conditions overall, not just in D.C. itself. I mean, we know we're going to see some short-term economic pain, particularly with a lot of the layoffs going on in the federal government. But there are broader economic issues related to Washington policy. And I am curious as to how you square that, particularly as a real estate investor. And I know you're long-term, but you are talking about structural shifts that will, if not change the economy, will certainly shift at least the direction of where that money is coming from in and out.
Yeah, look, I think one of the things that the market is beginning to pay attention to is the impact of the tariffs, the indirect impact of the tariffs, say, for example, on tourism. I mean, tourism and foreign travel to the U.S. is declining daily. So we're going to see significant declines in tourism, and that's going to hurt an already struggling hospitality market, especially in the major markets around the country. And I think that is another issue. Interest rates remain too high for many solutions. For example, New York City has an extreme undersupply of housing. Mm-hmm. And yet it's the highest rents in the country, but it's still not economical to build a building there because of all the regulatory restrictions and requirements, but also interest rates have nearly tripled. So interest rates have got to go down. And I think we're going to see that hurt Americans in a number of ways. Construction is a major producer of jobs. And contracting opportunities. And then, of course, Americans, the top two purchases are homes and cars. Both are interest rate sensitive. And so people can't afford cars and they can't afford houses right now. And I think that's going to continue to drag down the economy as well. And this tariff war has a short-term impact of reducing domestic jobs as well, because what we impose is going to get imposed on us too. And so it's going to reduce demand for our products as well.
Absolutely. I think everyone's in agreement about the short-term pain, but definitely some longer-term opportunities. Don, we have to leave it there. Don Peebles is chairman, CEO, and founder of the Peebles Corporation. We should also point out he did reference former mayor of New York City, Michael Bloomberg. Michael Bloomberg, of course, is the founder and majority owner of Bloomberg LP, the owner of the television network you're watching right now. And as you watch, we continue to focus in on the impact of those tariffs, which were announced yesterday. And that is a big focus of our top calls. The big movers on the back of analyst recommendations today. And we are going to start off with Lockheed Martin. This is the maker of the F-35 fighter jet. It got downgraded today by RBC to sector perform. The analyst citing, quote, greater headline risk for international sales amid strained geopolitical and trade tensions between the U.S. and Europe. Those shares down about 0.6% on the day. Then you had Ferrari. Geopolitical and trade tensions also an issue there. But analysts at Bernstein say they're comfortable maintaining an outperform rating on the stock because they say the ultra-luxury car maker can withstand the impact of U.S. auto tariffs, because if there is any customer out there that can afford to pay more for their cars, it's the Ferrari buyer. Those shares up, Alex, 2.6%. And finally, car gurus. This is in the retail space. JP Morgan downgrading to neutral from overweight, trimming their price target, saying that the impact of tariffs is unequivocally negative for the auto retail space. in the near and medium term. Those shares down 5% on the day, and those are some of our top calls. You can go through all the different auto companies, auto parts companies, automakers on the retail side, all feeling the effects. Those tariffs on fully assembled cars, they go into effect a week from now on April 3rd. By May 3rd, the scope expands to include parts like engines and transmissions. The big question now is, who are the winners and losers in all of this? Dan Levy over at Barclays joins us right now to talk a little bit more about that. You had a great note out. I love the headline here. No winners in the absolute, only relative winners. What does that mean, Dan?
Hey, Romaine and Alex, thank you so much for having me. Yeah, I think that the headline sort of says it all, is that with the tariffs in the near term, when we look at the OEMs and the part suppliers, which is our core coverage, there really are no winners. There's more cost, volume is going to be down, price is up. And so really, it's just a question of how the pain is distributed. There are relative winners, such as Tesla, maybe Ford as well, but there's going to be elevated cost for pretty much everyone across the supply chain.
Dan, simple question. Is all of this reflected in the stocks? I mean, we kind of knew this was going to be coming. Have they been punished enough?
This hadn't been fully reflected in the stocks, and we've seen volatility in the last couple months. Remember, we've seen a couple of head fakes on tariffs. We had the initial announcement in early February. There was supposed to be the imposing in early March, and both times it was delayed. I think that investors generally assume there would be some form of relief, maybe not zero tariffs, but I think investors generally were hopeful that there would be some opportunity for potential offsets. Now, we have to see what's happening on parts and what potential U.S. content benefits there are, whether there is an extended stay on the USMCA exemption. But generally, the outcome that we saw here was worse than what was largely anticipated.
I am curious, Dan, about what the demand side is going to look like for consumers buying cars. If we do see a material increase in the price of vehicles, and prices were already relatively elevated, you combine that with interest rates also that are relatively elevated if you are going to finance a vehicle, do you anticipate we would see a significant drop in sales themselves?
There will be a drop in volume and there will be an increase in prices. I think we have to figure out all of the offsetting items. So, for instance, you could have some automakers that are going to emphasize U.S. production, and we know that there is spare capacity in the U.S. So you could see increased U.S. production to provide some offsets. But overall, you are going to see a cut to volume because across the supply chain, you're going to see elevated costs. Mm-hmm. I think an interesting observation, the segment that's really going to be hit probably the hardest here is the mass market sedan crossover market. Those are the products that are most significantly brought into the U.S. from Mexico, from Asia. There is some luxury as well, but it's that mass market sedan crossover product where there maybe isn't as much capacity in the U.S. that's going to get hit a bit harder.
Dan, does that mean my Subaru has a nice resale value? In which case, maybe it's the rental companies, maybe it's the resellers that are actually going to do really well on this.
Used car pricing is probably going to be up. Anything that is linked to used car pricing is getting a boost. As it was in general, we were seeing with elevated pricing, you were seeing some consumers knocked from new car buyers to used. Just remember, into this news, SAR had been running at 16 million pre-COVID. We were at 17 million. The big difference really is that we're running at much higher prices today than where we were pre-COVID. That is probably going to magnify now. Now you're going to push more of those buyers that would have been new probably into the used market, and you'll see a further aging of the fleet.
Right, but then what do I buy if I sell it? That's always the problem. All right, Dan, thanks a lot. Really appreciate it. Dan Levy, Director and Senior Equity Research Analyst over at Barclays. 15 minutes from the closing bell. Lots of headlines, limited movement when it comes to the equity market. You're looking at the S&P now flat on the day despite the risk, despite the chaos. Mark Luschini is joining us next. This is Bloomberg.
we're suspecting that we're going to get an initial salvo of negative revisions to the S&P 500 companies as we go into the Q1 reporting period. This will, to a certain degree, begin to reset expectations, but it's pretty premature to say that we're going to be at the end of this. We think this is going to be an ongoing back and forth for months to come.
Scott Chronert over at Citi kicking us off to the close just about 50 minutes ago. A market that's really been oscillating between gains and losses all day long, now back in the red as we get closer to those bells.
I'm really stunned at the lack of move. I mean, clearly you have a lot of churn within the market, like autos getting hit. You saw the semi index not doing great, so those chips underperforming. But you know what's doing really well?
What's that?
Gold stocks. The
gold,
GDX is the major gold miners at a highest level that we haven't seen since January of 2013 as gold continues to grind its way higher. Talk about safe haven and equities.
Yeah, safe haven and equities. There was also a great data point. I don't know if you were looking at the latest trade deficit numbers, all the actual physical gold that's being rushed into the nation ahead of those tariffs, and something interesting. Also interesting, too, because yesterday you are also talking about transports, kind of the more boring industry. That's up for a second straight day.
I mean, so what does that say?
Yeah.
And the equal weighted index is not really going anywhere either. So I don't know. Is that glass half empty or full or both?
I guess it shows some people want to stay invested, and they are still finding some stuff right here in the good old US of A.
Some people buy stuff, some people sell stuff.
Yeah.
We make a market.
You should be a news anchor. Mark Luschini joins us right now. He's the chief investment strategist over at Janney Montgomery Scott. Hey, great. Thanks for joining us, man. Mark, where is your head at right now? Because we've been talking so much about, obviously tariffs in Washington, and then you can talk about, what's going on with AI and tech. There's a lot of things really driving this market right now. And I'm curious as to kind of what you are most focused on. What ends up being most important for you right now?
Well, to your point, Romaine, my head's on a swivel right now, trying to keep up with all the news items that are seemingly, obviously changing the headlines and then subsequently putting pressure on the equity market for good or for bad on a seemingly day in and day out basis. But at the end of the day, what I'm trying to discern is how much is, of course, signal from that which is noise. And we've seen a lot of bluster, a lot of concerns, obviously, that have escalated the uncertainty indices to all-time highs relative to certainly tariffs, almost completely ignoring some of the pro-growth features of the Trump administration that ran the bull market up going into the end of last year and just before Inauguration Day, almost as though they're still not ongoing and eventually will be that which will help to propel economic activity and, in our view, likely overcome whatever friction is applied to the economy by way of tariffs. But in the meantime, obviously, we're focusing on the hard data. You heard Jay Powell at the conclusion at the FOMC meeting the other day talk about, the differentiating the soft data from the hard data. And right now, yes, we acknowledge the fact there's been a pretty significant moderation in economic activity from the end of last quarter into so far the first quarter of this year. But it, in our view, remains positive nonetheless. Yes, GDP print for Q1 may come in negative due to that weird net import number, particularly as it relates to the disproportionate representation of something you mentioned earlier, which was gold imports. But nonetheless, underlying that, we still think there's enough strength in the economy that we're continuing to see an economic expansion that should be reasonably fertile for stock prices and corporate profits.
Where are the opportunities, though? I mean, even on a sector basis, if you buy into the idea that we're going to go through some short-term economic pain, but maybe potentially we get longer term, meaning by the end of the year, something that's a little bit more positive for the economy and, for that matter, the company's bottom lines. What are you buying? Do you buy like the beaten down tech stocks with the hope that they'll rebound, or do you go for more cyclical stocks? Where?
Well, I think there is an element of that, certainly. I mean, arguably the re-rating that's taking place in some of the Mag 7 related and even other tech adjacent names has brought them down to valuations that, while hardly cheap, are far less expensive than they were just 2 months ago. Having said that, when you consider the broad sectors that represent the S&P 500 or the U.S. economy, really only two have taken a pronounced decline so far this year, that being, of course, technology, and the other being, of course, consumer discretionary, which is largely attributed to the massive loss that's occurred in Tesla stock. If you look at other sectors, energy is up double digits year to date. You look at financial sector up upper single digits. You look at industrials, materials, and yes, of course, the classic defensive sectors like consumer staples and healthcare benefited from the rotation out of the higher beta names into more defensive areas of the market. But this broadening, I think, is quite constructive. If you look at the Russell 1000 2000 value index, for instance, it's up almost 3% year to date, while the S&P 500 is down almost the mirror opposite, almost 3%. And it really speaks to the fact that there's still shopping to be done in other sectors of the market that really belie what the headline is suggesting, which is the market, yes, while down, still more than 7% from its recent peak in mid-February, has not necessarily inflicted the same level of pain across the entirety of the market, more so concentrated in those handful of large mega cap name and related stocks that have undue pressure applied to the stock market's capitalization weighted benchmark.
Hey, Mark, before I let you go, I've been wondering this all day. Does the tariff strife right now and the chaos there sort of obscure the fact that the AI tech trade is really rolling over and there are some serious issues there? How do you see it?
Yeah, I think it does, Alex, to be fair. I mean, if you consider the fact that actually those Mag 7 stocks, which are dominated by AI-related names, really began to roll over in mid-December. And this is when there was still a lot of hype around AI. And well before we thought we would see the sequencing under the Trump administration of tariffs really, taking an overarching narrative above all the other matters of policy that are likely to ensue under the Trump administration. So I think investors became increasingly skeptical toward the end of last year about not only the promise of AI, but mostly the spend associated with it, whether the return on equity would translate either at all or at least as quickly relative to the amount of expenditures that a lot of companies were paying for all that was necessary to be able to grow their AI business. And so I think that remains a problem for a lot of stocks in that industry. Not to say they're broken, not to say they won't grow, but the growth rates built into those lofty valuations are going to take a while to be remet.
All right, Mark, great stuff. Got to leave it there. Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott here, counting us down to those closing bells here. Kind of a half and half day here, Alex, with about half the S&P in the green. That's led by names like Apple, MasterCard, Microsoft, but then you have the big drag coming from NVIDIA, Broadcom, Meta, basically all the other tech stocks, and also the financials getting dragged down as well.
Yeah, and Broadcom getting hurt. Obviously, the autos getting hurt as well. We saw GM still down by about 6%. But the overall churn on a headline level, I am surprised that we're not seeing more volatility on a headline level, to be honest.
Yeah, I mean, maybe some of this was priced in. Maybe also this is just about, at least for right now, just about cars. And I think a lot of people still want to see what the retaliation is. We heard from Mark Carney earlier. He said he's going to retaliate. He didn't exactly say how and when, but something's coming.
In a way that will hurt only the U.S. and not Canada.
We are breaking down all of the market coverage with our global simulcast. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you to that closing bell with a global simulcast. Starts right now. Scarlett Fu here in the TV studio. Carol Massar, Tim Stenovic in the radio booth. Welcome to our audiences across our Bloomberg platforms, including our partnership with YouTube. A down day, Carol Massar, but as Alex was alluding to a little bit earlier on TV here, it could have been a lot worse. Yeah, it could have been a lot worse, especially if you look at some of the automakers, right? You would have thought, wow. I mean, the sector, depending on how you look at it, auto parts versus automakers, foreign automakers, but Ford and GM right now taking it really on the chin here. Ford is down, about 3.6%, and GM down about 7%.
Okay, so the S&P 500 is down about 0.3%. It's moved between gains and losses at least a dozen times today. It kind of masks some of the bigger moves that are taking place underneath, whether it's a Dollar Tree going up by 11% or a GM down by more than 7%.
It also masks the idea that gold continues to rally. I mean, with the advance in gold, it seems to signal a lot more concern, a lot more alarm than what's actually showing up in equity prices.
I love that you said that, because the GDX, which tracks the big gold miners, is at its highest level since January of 2013. It was like a whole different world for gold. So within the equity market, there is still a little safety rotation.
Yeah, absolutely. And you saw that reflected also in some of the moves that we saw in the Treasury space. And we were having a conversation on television a little bit earlier with Pimco's head of leverage finance here. He's still seeing a lot of opportunity when it comes to high yield debt, junk bonds, as well as leveraged loans here. We get the closing bells in New York on this. Thursday. What is it? Thursday afternoon?
Friday Eve, guys. It's Friday Eve.
You sound tired too.
On this Thursday afternoon here, the bells being rung. Actually, look at that. Dow Jones ringing the bell there. Although that's appropriate. The Dow Jones Industrial Average closing lower on the day by about 160 points, or about 0.4%. The S&P down about 19 points, below 5,700, or about 0.3%. The Nasdaq Composite down about 0.5% on the day. Your big decliners on the day, though, were in that mid-cap space. S&P 400 mid-caps are down 0.7%, and as far as the Russell 2000, that's lower by 0.4%.
All right, once again, a day where we're kind of getting a little bit of an even split here on the S&P 500, although I don't know what's going on. I'm a little sleepy, and I think my terminal's a little sleepy. I can't bring up the numbers, but it's about an even split here in terms of gainers and decliners.
Yeah, 286 down, 214 up.
Thank you for that.
All right, let's take a look at the IMAP, and that lopsided move towards decliners shows up here in the IMAP. You do have three sectors in the green. There are some of the smaller ones, consumer staples and healthcare. Staples is really the big winner here, up 1%. Consumer discretionary, little change, but somewhat higher, and that is because of a gain in Tesla. Energy, communication services, and tech are the big laggards of the day.
All right, guys, let's get to some of the individual gainers. Petco, definitely on that list. Love the ticker, woof. Stock up about 31% here at the close. First quarter earnings forecast topping expectations. Company closing underperforming stores. We know some of the story there. Analysts were pretty positive on the firm's focus on profits over sales. I will point out, though, you did have some analysts cutting their price targets on the stock, but nonetheless, investors kind of liking it today. I will also point out stock's down about 10% for the year, and about 40% of the float is shorted. So
you have a dog, right? A pet?
I have two dogs.
Oh, wow.
Yeah.
So, okay.
Yeah, I'm spending lots of money.
Back to that discussion yesterday, Romaine, about how this is a staple, not a discretionary expense.
I know. I mean, I don't know if I know you watch our show religiously, Carol Master, but Scarlett and I interviewed the CFO of Rover, who made it clear that pet parents, as he says, are going to keep spending. By the way, put your dog in the will, of course, he says.
Listen, what is the dog going to do?
Yeah, no, that's my wife said last night, too.
Put him where?
No, put in the will. In your will.
Oh, he wants to make sure the dog is just as well set up for success as his kids.
Stranger things have happened.
All I know is I want to come back as my dog in my next life. I'm just going to put that out there.
Living the life there.
Yeah, exactly.
I wonder what she's doing right now.
Dollar.
She's laying on the bed, on the floor.
She's not concerned about tariffs.
Laying on the down comforter. Totally. All right, Dollar Tree down, actually up about 11%. I'm doing gainers. Where am I? All right, rolling for a second day.
Don't interrupt her.
I am exhausted right now. I feel like I need a cup of coffee. Dollar Tree up about 11% here, 2 days in a row. Top gainer in the S&P 500. We did have Evercore ISI coming out, raising the firm's price target on Dollar Tree to 85 from 79 a share. Stock closing just below $77 a share. So that was at play. We know the story. The company announced the much anticipated sale of its Family Dollar business. So anyway, a little analyst movement there. Avis Budget, we talked about the car companies, right, under pressure.
Yeah, this was amazing.
Avis Budget up about 18%.
Yeah.
Hertz also rallying big time in today's session on those planned 25% tariffs from the president on autos. So basically the thinking is our own Steve Mann weighing in, new vehicle prices, if they go up, the used vehicles the companies sell become more attractive. So that's kind of some of the reasoning there. So a lot of movement there. And one more, I know I'm only supposed to do 3, but what can I tell you? It's that kind of day for me. Up about 2%.
She's never going to stop.
I know. It was a top gainer in the NASDAQ 100. Thinking is Tesla, because they make a lot of they produce here in the United States, that they're going to be okay. Although they do import some parts from overseas. I am done.
You're done?
Metaphorically.
Okay.
Sorry. Yeah,
All right.
I am. Thank
Let's
you.
do some more on autos. General Motors down 7.4%. U.S. automakers fell after, well, not Tesla and Rivian, I should say, after the president hit auto imports with a 25% tariff starting next week. It's hitting Detroit. It's not just hitting international automakers, as we heard earlier from our man in Detroit. On this day, Keith Naughton, who was really talking about how even though Mary Barra and the chairman of Ford were in Washington, D.C. trying to make their case, they're still obviously very, very concerned about what this looks like. Anything can happen over the next month, but as of now, it looks like these tariffs will go into effect. AMD shares fell 3.2% today. This after Jefferies downgraded it to hold. Jefferies said that AMD is falling further behind when it comes to its tech, behind NVIDIA when it comes to its tech, which could continue to pressure the stock. Shares of AMD have fallen about 50% from a peak about a year ago. At least 8 firms have lowered their view on the company this year. And finally, a late day addition is AppLovin, a short report came out. Shares fell 21% today. Muddy Waters issued a report against the company. At least it's the third report from a short seller in about a month. This specific report alleges that App Lovin misrepresents the benefits of its AI platform, forces app installations, misappropriates data, and violates the platform's term of service. Should note that the company did previously respond to February reports saying that they were, quote, full of inaccuracies and false assertions. It did rise more than 700% last year. Remember, this was one of the best performing tech stocks. It was also added to the NASDAQ 100 recently as well.
All right, let's get a read on what's going on in the retail space. Lululemon out with its report for this fiscal fourth quarter. The company said that revenue came in at about $3.61 billion. That's a beat. EPS came in at $6.14 a share. The street was looking for $5.85. That's a beat. This is for the quarter that ended at the end of January. Their fiscal first quarter guidance, they're saying that revenue will be $2.34 billion to $2.36 billion. The street on average was looking for $2.39. As for EPS, the company said look for $2.53 to $2.58. The street was looking for $2.78. So the top end of that EPS range that they're giving is below the average of street estimates. You're seeing the shares lower in the after-hours trade.
All right, let's stay on the retail and apparel side because Oxford is another company we're watching. That company reporting results. It owns the trademarks of Tommy Bahama, Lilly Pulitzer, Southern Tide, and Duckhead Lifestyle.
What?
And yeah, that's right. The company reporting fourth quarter adjusted EPS beating analyst estimates, $1.37, 10 cents better than what analysts had anticipated. But for the outlook for this quarter, that does come in lighter than expected. First quarter net sales will be at most $395 million. Analysts were looking for something north of $402 million. And first quarter adjusted EPS will be at most $1.90, long way off from the consensus estimate of $2.73. Nevertheless, Oxford raising its dividend, so that stock may be paring some of its or limiting some of its losses as a result of that increased dividend.
All right, guys, going back to where equities and where assets settled for today, I'm taking a look at the bond market. So no surprises. You saw a little bit of risk off in the morning, you saw a little bit of bid in that front end, but honestly, it was a very calm curve. You do see that 2-year yield now below that 4% level. We had the final 7-year auction later today. It was all right. I mean, it wasn't great. It wasn't terrible. It was just okay. But there you are, a little lower yields. The belly not really doing that much, guys. It's surprising how calm it feels the bond market has been.
Yeah, really interesting. I just want to go back to Lululemon for a moment, just looking at the release. Megan Frank, the chief financial officer, talking about another solid year of performance and so on and so forth, but says we look forward to building on our growth in 2025 while remaining agile as we navigate ongoing macro uncertainties. You know, it's going to be super, super important as we start to get into the next earnings season, what CEOs, CFOs, they all say about the outlook. I feel like I've heard the word uncertainty a million times this week alone because people just don't know what's coming at them next, certainly those who run companies.
Absolutely. Carol?
Oh, am I supposed to finish?
Yeah, we're actually done. Yeah.
And back to you, Carol.
Almost Friday. Almost Friday. All right, guys, that is a wrap across platform. Thanks for putting up with me, that's for sure. Radio, TV, YouTube, Bloomberg Originals. We will see you again. Same time, same place tomorrow. Alex is heading out. Scarlett remain finishing up on TV, and we're going to finish up an hour to go right here.
We're not done yet.
You can do it.
Radio.
You can do it.
All right, we'll see you tomorrow, guys.
All right, our full coverage of everything going on in Washington continues when we come back after the break, but this time through the lens of Canada. The president and CEO of Canada's biggest bank, RBC, Dave Mackey, is going to be joining us in just a few minutes.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting day on Wall Street. We thought we were going to get a big sell-off. Then we thought we might get a big rally.
It was like a shrug in the end.
And it was kind of a shrug, exactly. It closed down on the S&P 500 by about 0.3%. Alex Steele was saying a little bit earlier that she was kind of expecting a much more significant reaction in the market to those Trump tariffs. But we did get a reaction. It was just kind of confined to some very specific sectors. And of course, that is the automotive sector. The automakers moved lower. A lot of the auto parts companies moved lower there. on the day. Though there was an interesting story in that Scarlett's going to get to about some of the folks in the auto space that actually did well. Meanwhile, you did see the peso strengthen here on the day. But this was also still a story, and we should point this out, about tech stocks and the lack of leadership that we're seeing there. A lot of concern still about the AI build out, whether that was overspent, and more importantly, whether those valuations on some of those names were actually a little bit too high.
Yeah, that's a big question mark right now. It's something that investors continue to reassess as time goes on. As promised, let's get to a couple of those auto names within the auto sector. GM down about 7.4% on the day. That is the biggest slide in 2 months, of course, after President Trump announced those 25% tariffs on autos. Now, what's interesting here is Tesla bucking the decline, up 0.4%. It had gained as much as 7.3%. Analysts say that it is the least exposed to the tariffs, in part because most of the cars it makes in the U.S., it sells in the U.S. So its production in the U.S. Removes the need for paying tariffs, except on a couple of parts. Meantime, you look at Hertz and Avis, big gains here, 20% advances for the rental car companies, because if new vehicle prices go up because of these tariffs, then the used vehicles that these rental car companies end up selling will also go up as well. They become a lot more attractive. And of course, Hertz and Avis do rely on sales of their fleet to boost their revenue and their bottom line. Romain?
All right, we do want to go back to Lululemon. Taking a look at those shares right now, under pressure right now. We should point out that in the most recent quarter, the quarter that ended at the end of January, their fiscal fourth quarter, they did beat on the top and bottom line. They did provide guidance for the current quarter. On the revenue side, the top line, it does look like they will come in line with estimates, but some concerns here about the bottom line, the EPS guidance that they're giving below the average of street estimates. A lot of questions right now about the health of the consumer and what they're willing and, more importantly, able to spend on. Wendy Liebmann knows more about that than anyone. She's the CEO and chief shopper at WSL Strategic Retail. Nice to see you.
Good to see you too.
Lululemon was always been kind of one of those kind of, recession-proof, for lack of a better phrase, stocks. It was like people spent there when times were good, they spent there when times were bad. Do they still kind of have that aura around them?
Yeah, to some degree, because they're in a category, they're quality, they build a community around the brand, so there's got a lot of integrity around it. Now, shoppers are sitting on their hands somewhat, waiting to see what's next. And that uncertainty means even with a brand like Lululemon, they are being cautious. And so that's the big story.
Well, when do we need to start worrying about that? I know there was a lot of talk towards the end of last year how we were seeing some pain amongst lower income consumers. And people were saying, okay, well, as long as the higher income consumers continue to spend, particularly on discretionary things, everything will be okay. Have we seen any real cracks in that higher end consumer?
Beginning to, that sense of I can afford it, but do I need to spend it now? They're the ones who are most concerned and connected to the stock market. So they're the ones who are feeling, potentially what might happen. And there are a lot of other options that are good quality, not quite that price. So, people with higher incomes are also smart about how they spend. And so, being cautious is what everybody's waiting for at the moment to see what's next.
You mentioned a lot of other options. That's certainly the case for people who are Lululemon fans. They can go to Vori, they can go to Alo, and they have been doing that, at least in the U.S. Now, one thing that we've noticed, or that analysts have noticed, is that there's a lot more promotional items on sale at Lululemon. How much is that dilutive to the brand? Because until recently, Lululemon did not put a lot of things on sale. It was able to get full price for almost everything.
I think that's something that people start to say, listen, is it a fair price? Is it a good price? Was I paying too much before? I love the brand. I mean, we see that in our latest How America Shops research. People say, I love it, but do I really want to spend all that? I'll wait till it goes on sale. Before, it rarely went on sale, so you didn't have an option. So I think that's what we're seeing now in this turmoil of people saying, I want to be smart, I love it, but should I wait another month? Do I need another pair of leggings? Can I wait till June and see what happens? And I think it's that uncertainty that makes a difference in the marketplace now.
You call yourself a chief shopper. When you actually go to the stores of Lululemon, of any of these wellness or athleisure companies, what is the thing that jumps out the most at you? I mean, how have they adapted to the new environment that we're in, with all the uncertainty, with this more discerning consumer?
Yeah, I think that many of them are trying to add value. You walk into a Nike, you walk into an Alo, and you see an experience about service, about how quickly you want to buy it. Do you want to buy it online? Do you want to buy it in store? We've got people to help you buy the right thing. So they're sort of adding value, not just discounting. And I think that's a really important blend in that experience. and, Lulu just opened a new store in London. High test of experience, all of those things going on that if you want people to pay premium today, you've got to add that value to it.
What's the balance, though, right now between those companies that have more of a retail presence? And we've seen a lot of brands, particularly the newer brands, that have basically taken a straight direct-to-consumer online presence.
Yeah, I mean, that's the efficient way. Everybody's up to their ears. Nobody's got time. What do I do in the middle of the night? I need a pair of something. Click, I'll do it. It'll be here in a day or whatever. However, the brands that really last and have integrity are brands that do both. It's a sort of connected commerce world any way I want it. Yeah. And if I have time, I love the experience. I love the community of a Lululemon or an, Arlo or a, whatever you want to add to it. That experience really does matter in building a brand for the longer term and getting people to pay, everyday prices, not everyday low prices.
Where are these apparel brands in their ordering for inventory for the summer and for the fall? Have they already put in their orders already? Have they rushed them to get ahead of tariffs? How much room do they have to make adjustments right now?
Yeah, that's sort of uncharted territory. Some that got ahead of it. But the uncertainty, again, I keep using that word. I don't mean to be redundant, but that not knowing what the market's going to look like. Most of the fashion brands are in-house already unless you're doing stuff in the U.S.
All right, good stuff. Wendy Liebmann, really appreciate your joining us as always, CEO and Chief Shopper at WSL Strategic Retail. All right, coming up, escalating tariff threats as well as lingering economic uncertainty. Those are the themes. It's been the themes for the last couple of weeks. We're going to discuss all this next with Veronica Clark. She is a U.S. economist at Citi. And later on, Dave McKay, President and CEO of RBC, will be joining us as well. This is The Close on Bloomberg. Economic uncertainty proving to be a major overhang as tariffs and higher prices continue to pressure the consumer. We've got more economic data coming out tomorrow, starting with the Fed's preferred measure of inflation, core PCE, expected to hold steady at 0.3% month over month. Year over year, we're looking at 2.7%. That would be a pickup from the 2.6% recorded in the prior month. Joining us now is Veronica Clark, U.S. economist over at Citi. We pay so much attention to core PCE. Do you think the numbers tomorrow will be market moving?
Yeah, so it was really interesting when Chair Powell had the press conference last week. He mentioned that the Fed is expecting to see 2.8% year on year for tomorrow. Now, most of core PCE, we already know it's usually not a market moving event. But interesting that the Fed thinks it will be a bit stronger. Maybe if we see that, we get a bit of a move. But if the Fed is already thinking that, that's not necessarily a surprise for them. And maybe the Fed is surprised that it comes in a bit lower than they were expecting.
Okay, so the Fed is looking for 2.8. The consensus is for 2.7. The previous month was for 2.6. Either way, we're looking at a steady ratchet higher. Inflation has picked up this year. We know that. What's your level of concern that it will continue to accelerate?
Yeah, so we've seen this start of year strength. That's the January and February prints. It was less than that residual seasonality we saw in these months last year. So in that sense, it's looking a little bit better. But now as we're getting into the spring and summer data, that's when we have to worry about tariffs and how that might impact goods prices. Maybe it already is impacting prices some. Chair Powell kind of said that last week. I think if we look at the details of the inflation data this year, we're not going to be so concerned about the real persistent inflation, though. And I would kind of agree with the Fed characterization that maybe some of this is transitory, because I think we will see slowing in things like services prices, shelter and services broadly. I think that will look a lot better this year.
When we talk about this idea of inflation expectations this time around, what's different about what we saw a few years ago when inflation expectations then were also rising?
Yeah, the main difference is that this is a pretty different economy. There are not particularly tight labor markets right now. The consumer, we've seen consumer spending slowing the first couple months of this year. Savings rates are very low. Delinquencies are pretty high. And already in 2024, we anecdotally definitely heard that it was harder to pass on price increases. So yeah, we will probably see some of the pass through from tariffs, but we wouldn't be so concerned that it's this broad-based persistent inflation, because because the economy is a lot weaker than it was in 2022.
Are you optimistic, though, about consumer spending? I guess, bullish, for lack of a better phrase, because there's a lot of measures people will look at, and they'll say, look, at least the hard data, we're not really seeing the slowdown there. But then you get sort of these weird data points, and somewhere in their backward looking, car repossessions at the end of the last year, highest level since 2009.
Yeah.
Credit delinquencies and other things also on the rise as well. When do I need to start being concerned?
Once we see the labor market really turning, because there are a lot of risks for the consumer. We have started this year with some softer spending data, retail sales for January and February. Certainly the consumer confidence measures are a lot weaker. That doesn't always translate to actual pullback in spending. But if we do see more weakening in the labor market, which I think we will this year, then that is a game changer for spending.
And so it's for that reason, in part, that you are sticking with your expectation of 5 interest rate cuts for this year, for 2025. How do you see this playing out? Like, at what point does it start? What's going to be the catalyst?
Yeah, we are still penciling in the first rate cut in May. Now, maybe risk that would be a bit later. But I think it's really the labor market data that we're going to get for this spring and summer. So that does include the 2 reports that we'll get before the May meeting, for March and April. But maybe especially over the summer. This is a time of year usually when hiring is supposed to pick up, and that's really been the driver of a weakening labor market the last 2 years. We have seen the unemployment rate rising, right? And most of that increase has happened in the spring and summer when businesses are supposed to be hiring. Maybe added uncertainty, tariff costs, weighs on hiring even more. Obviously, then we're getting into federal worker layoffs in the summer, and that could add to this weakness. So once we start to see that unemployment rate really breaking above the range it's been in, I think that's a Fed that gets more worried on their employment mandate.
And do you see that filtering through to the real economy? I mean, are we going to see yields come down and therefore mortgage rates start to come down in a meaningful way?
Yeah, we could. I mean, certainly if the Fed is cutting, you're expecting 2-year yields, the short end to fall more. The long end might still be determined by deficits and things like that. But we certainly could see that, mortgage rates coming down. But I think if this is a truly weakening labor market and weakening consumer, then that doesn't necessarily boost housing demand as much as you might think otherwise.
When you talk about the weakness or potential weakness for the labor market and that being the thing to look for, I know we're sort of focused on what the actual report out of the government says. As we start to go through this next earnings season, a lot of these companies are going to have to articulate some sort of outlook. Maybe not a hard outlook, but it's certainly going to be asked about sentiment. Do you think we'll learn more from that than maybe what we could learn from those actual reports before we get them?
Yeah, sometimes those sentiment, those anecdotes can be a good indication of what companies are experiencing. We read the Fed's beige book for that reason too.
This is the time for the beige book to shine.
Yes, exactly. There's always good anecdotes in that. And so far we've mostly heard, which is what has been consistent with the employment data, is businesses are not hiring. They're not necessarily laying people off in large numbers yet. But if you are cutting back on hiring, trying to reduce your labor costs, I would be worried that layoffs are still that next step, and maybe we hear it in anecdotes first.
Any downward pressure on wages?
Yeah, I think if the labor market is loosening, you will see that wage growth slowing. In some of the details of the wage data, it does look like people are already not getting big wage bumps when they move jobs. There's maybe still some lingering wage pressures if you've stayed in your job the last few years, coming up to a higher market wage. But that demand for new workers, I think, has already really pulled back.
All right, Veronica Clark, U.S. economist over at Citi. A nice preview of that PCE data that we get tomorrow morning, 8:30 a.m. Washington time. And of course, the market has been riveted by what's going on in Washington and those trade policies. We're going to get a view from the other side of the border. When we come back, a conversation with Dave McKay. He's the president and CEO of RBC, that is Canada's biggest bank. This is Bloomberg. Trade tensions escalating once more between the U.S. and Canada. President Trump imposing those automotive tariffs set to take effect next week. Canadian Prime Minister Mark Carney, well, he's vowing to fight those tariffs with retaliatory action. He's saying that nothing right now is off the table, and he will use every measure to protect the Canadian economy. Canada's largest bank, RBC, coincidentally was holding its investor day today. CEO Dave McKay warning there that there could be some short-term volatility and that the economy over there, that they will have to adapt. I'm pleased to say that Dave joins us right now, coming fresh off of that investor day. And I do want to start there, Dave, because the numbers you gave were pretty impressive, not so much because they changed, but more importantly, you said you're standing by them. You guys have had long-term targets in place for years now. A lot's changed over the last few years. A lot's changed over the last few weeks. What makes you comfortable in standing by those targets?
Well, thanks for the opportunity to join you today. And yes, we just finished our Investor Day, first one we've done in 7 years. And when you think about all of the targets and strategies and opportunities that we articulated today, it was very much about the medium and long term. These are opportunities in the United States, opportunities in Canada, opportunities in Europe, and we're certainly, whether we have a tariff war and dispute and whether there's a short-term dislocation or medium-term dislocation, these strategies kind of supersede that, whether they're growing in the transaction banking space in the United States and globally, growing our commercial bank and mid-corporate bank in the United States, or our wealth management business in the U.S., focusing on generative AI and the significant impact AI is going to have on our business. All of these kind of transcend the short-term dislocation of a trade challenge and an impact on the economy.
Yeah, certainly.
Therefore, we still thought it was really important to tell our story and to go forward. And we're going to have to deal with those challenges, as I'm sure we'll talk about. But what we're working on really transcends that over the medium term.
Yeah, certainly so. And I'm in agreement with that. And we talk about this idea. We introduce you as, of course, having the largest bank in Canada. But really, I mean, you're banking customers in a big way on both sides of the border, not just so they're in Canada, but you have a huge presence here in the U.S. Do you not worry at all, given the political climate and for at least what right now seems to be a very tenuous relationship between the leaders of both countries, that you may actually have to pick one side of the border or the other?
No, as you mentioned, we're not only the largest bank in Canada, but one of the largest banks in the world. And a number of our businesses in the United States are top 10. We have a top 10 capital markets business in the United States. We're the 5th largest wealth manager in the United States. And we've got a top 25 commercial bank. So the United States is very important to us. And when I look at this 100-year relationship between Canada and the United States, built on trust, built on economic interests of both sides. And today we have a balanced trade agreement between the two groups. $400 billion of goods and services trade go across the border each year, and therefore Canada is a very relevant partner to the United States and makes America more profitable, more competitive, and more secure at the end of the day. So I think when we look at that relationship, and we hope as we sit down and we go through these discussions, there continues to be bilateral discussions between both countries. There is strong rhetoric in the market, but when you get down to the basics of the relationship, it's so important to each country economically that we're just hopeful that the outcomes over the next week or 2 weeks find their way into that bucket that doesn't disrupt what's been a very profitable and important economic integration and continued opportunity. And for Canada, this presents an unparalleled opportunity to transform our country and get some things done that we haven't been able to get done over the last decade.
And we'll get to that in a moment, but when it comes to the economic impact from the tariffs, at least here in the United States, there's a lot of concern over the uncertainty that results in, and perhaps the paralysis that companies and consumers will experience, perhaps slowing the economy. There's a rising number of Canadian business leaders who also fear that a crisis is looming, and many of them are worried that the economy could slide into a recession. Is that your base case scenario as well, that Canada would tip into recession?
That is not our base case scenario, but certainly a potential scenario given the severity of the tariffs and particularly the reciprocal tariffs that we'll learn about more on April 2nd. So no, we've certainly seen lower interest rates in Canada stimulate consumer demand. We've seen lower interest rates in Canada stimulate commercial demand and hiring. Our unemployment rate went down towards the end of the year. We saw good mortgage growth, and all that, to your point, has slowed with the uncertainty of the impact of tariffs. So we're seeing less home sales. We're seeing businesses pull back. We're seeing pipelines in our M&A activity. All banks globally, from Goldman Sachs to ourselves, are talking about customers pausing on the M&A side. So all that, we have seen an impact just from the rhetoric of the impact of the tariffs have slowed the economy. And now we got to see what sectors it impacts, what's the magnitude and duration of the tariffs, and then businesses can adjust. Some businesses can absorb the impact on their margins. Some will pass it on to consumers. Some will innovate and find new customers in other markets for it. So it's not like the pandemic where the economy shut down within a couple of weeks and we had a dislocation. This will take time to play through the economy.
Right.
There are shock absorbers in the economy. Government will come through with some programs to buy businesses time to absorb. So it's very much a different scenario than the pandemic. And we just have to sit back and not overreact and get to the best place possible.
So whether Canada tips into recession or not may just depend on leadership. And Mark Carney is the new Prime Minister of Canada, at least for the next month, maybe longer if he actually wins the election in late April. I'm curious how you think he's managing the economy and this interim period as Canadians get ready to head to the polls.
We'll go through the democratic process and decide kind of which prime minister, who gets to be prime minister, which of the 4 or 5 incumbents who are trying to compete for this. I think what's really important that whoever gets elected is that we pursue this opportunity that's in front of us to transform our economy, get rid of the barriers to growth that slowed us down for decades that we haven't got done, get big projects approved, whether they're energy projects to the West Coast, to Asia, energy projects to the United States, more LNG to the United States, rare earth minerals that the U.S. and other markets need, food and agriculture. We have a huge hothouse capability and growing more capacity around feeding the world. All of these we've been slow to develop, and therefore we have this opportunity. So as Canadians, it's really important that we debate who leads this country and who can execute that mandate. Prime Minister Carney has only been in the job for a couple of weeks. He hasn't had a lot of opportunities, called an election already. So very much we're in this period where the government's distracted. All levels of government are distracted around running for election. We have a very shortened campaign, particularly compared to the United States. There's about 4 weeks left before we go to the polls. That's a focused time for Canadians to decide who they want to lead the country. And yes, it will be hard to do both. And therefore, business has to step in, premiers have to step in, and we have to get through this period. And I think the U.S. administration recognizes that Canada is distracted during this election period, and therefore, more attention can be paid when we get to May. So I think that's the way things will play in our country. And I think, we're looking forward to moving through this democratic process expediently and making a decision.
With regards to the structure of your business, and particularly some of the changes that have been made, you obviously had that big acquisition a year ago of the HSBC assets, the Canadian assets of HSBC. I mean, that sort of provided a little bit more of a domestic focus, or at least bolstered that domestic focus. Do you anticipate that the growth of this company, given geopolitics, you might have to bolster your Canadian presence even further?
Well, to your point, HSBC was a fantastic acquisition for our customers, our franchise, and for our shareholders. And we reaffirmed today our $740 million of expense synergies. We're about 90% through that. We talked about an additional $300 million of revenue synergies coming from that deal. So it's been incredibly accretive to our organization and to our shareholders, and we're incredibly proud of that. But when you heard where a lot of the growth is going to come from, it's from the United States. And therefore, despite all the success we're having with HSBC, we still forecast roughly the same balance between Canadian and non-Canadian earnings, which is 70-30 right now, to maintain that ratio over the next 5 years, given such strong growth opportunities in the United States. From City National Commercial Bank and Entertainment Bank has great opportunities for more productivity, new mortgage origination and servicing capability, cross-selling products into our ultra-high net worth business. Capital markets articulate a strategy around FX and equity finance and equity derivatives, more growth in our investment banking franchise. We have 2% market share right now. We aspire to go to 2.5%. So when I look at the opportunities in Canada, they're matched or exceeded by the opportunities in the United States.
Well, I'm glad you went there, too, because I am curious as to what's going on right now with City National. Obviously, that did not necessarily get off to the best of starts. I am curious as to what you're articulating to investors right now about City National's role under the RBC umbrella. Is there going to be an expansion of that mortgage business? Is there going to be an expansion of the direct lending business? Is there going to be an expansion of wealth management? Where are we going to see the biggest growth?
Well, we have 3 major pillars, as I said, in the U.S. So I've talked about the capital markets and wealth franchise who have very strong growth opportunities. So City National, we're replatforming the business now. I would say we had significant success and we grew too quickly with City National. We tripled the size of that bank since we acquired it in 2015, but we didn't keep the risk and compliance and technology platform didn't keep up with the growth of our customer franchise. So we now growth has slowed a bit. We have this opportunity to re-platform the business, and that's been a source of significant cost and effort for us, and we're working through that very nicely. So I would say from a customer franchise perspective, we've been extremely successful, but we got to get the risk and control infrastructure up to speed. And that gets us to one of the few heightened standard banks in the United States. And we think that's a great position to build off in the mid-corporate and commercial space going forward.
How far along are you in that process? Are we near the end of it?
Well, as we signaled to the market, we think our peak expense rates are at their max now, and we start to roll off some of that cost going into 2026 as we continue to complete key stages in that overall journey, and the cost structure should come down from here. So that's a part of the investor thesis that we presented today, that we're at max run rate. And as we complete the various segments in this journey, our cost structure will come down. And that's a fairly material contribution to RBC's profitability and certainly to CNB's profitability, as we can reduce the level of complexity in the organization and reduce the cost structure of the organization.
Can you talk a little bit about your ambitions in Europe, outside North America? The idea that you're going to be focusing more on growing that business. Will it come at the expense of the U.S.?
No, I think the beauty of being one of the largest banks in the world and having the capital generation ability that we have today organically, we're running the bank at 13.2% CET1 ratio. We have 75 basis points a quarter of organic capital growth. Allows us to do all things at the same time. We have enough capital to grow Canada the way we've talked about. We have more than enough capital to grow capital markets and commercial banking and be strong partners to U.S. businesses. At the same time, we have organic and inorganic capacity in Europe and the United States. So when you have such strong profitability and high ROEs, capital efficiency being a big part of our investment thesis, it gives you more cadence to reinvest in the business. Therefore, that's the beauty of our franchise and our investment thesis, and why our stock has performed so well, is that organic capital creation and our ability to do all things at the same time with our capital base. At the same time, we have operating in data and technology scale. We spend over $5 billion a year in technology. I'm able to execute programs. I gave an example to the investor group today where we delivered on the most complex integration of a bank any bank's ever done, particularly in Canada, of HSBC. At the same time, we built a brand new global transaction capability. At the same time, we're building this commercial banking replatforming that I just talked about. That capacity to do that, plus the generative AI work that we're doing, means we have technology, data, business scale that allows us to do so much at the same time. So the answer is we're going to do it all.
Okay, so AI is a key tool to get there. I want to wrap things up, our conversation, with something you had said earlier, which is the next prime minister, whoever he is or she is, well, in this case he, will need to transform the economy. And this idea that Canada needs to kind of go back to its roots, which is a resource economy. Talk about the priority that means perhaps the energy sector, the agriculture sector, the resource sector will get from RBC.
It's a great question. So we're very supportive of all our sectors in Canada, being Canada's largest bank. And we're excited about the incremental opportunities around infrastructure that really adds to Canadians' prosperity and helps our global partners. So building more pipelines will be important to the Canadian government, particularly as it helps countries like Japan and Korea with their LNG needs. Building more connectivity to the United States is really important, and therefore we plan, if it's important to our country and to our government, then it's going to be important to us, and therefore we'll follow that lead. But certainly we have the balance sheet capacity and the energy expertise. We're one of the larger energy banks in the world, supporting what's an important part of this overall transition to a greener energy infrastructure, obviously, but a more secure energy infrastructure is increasingly what's being talked about between energy security is now very high on the agenda of all countries, particularly Western countries in North America.
Dave, really appreciate your taking some time to speak with us on your Investor Day. Dave McKay is president and CEO of RBC. I thought that was really interesting, especially as it relates to Canada being a resource economy. He mentioned green energy. I don't think anyone in the U.S. has talked about green energy since November.
Yeah, I mean, there are a lot of other implications, too. I mean, we talk about, obviously, softwood lumber. We talk about even the services sector. And like I said, you're talking about a bank there that really is kind of straddling the border, a Canadian bank, to be sure. But as you know, just from all the folks we have on our show here, they have a huge presence in the United States and here on Wall Street. And it also gets to this broader idea as we still haven't learned exactly what the response from Canada is going to be. What can Carney do, particularly given you have an election on April 28th? So does he implement something now that could maybe be reversed if he's not actually elected? who knows?
Yeah, well, like you said, they're not distracted so much as they've got a lot on their plate right now. And first and foremost is figuring out leadership in the next month.
Yeah, well, speaking of leadership, we want to talk a little bit about corporate leadership and about some of the corporate initiatives to actually keep those companies going. Remember when DEI was on the lips of every executive out there? Well, that's not really talking about it much anymore. Bloomberg scanned through the annual reports and showed that there's been a drop of about 50% in mentions of that phrase and derivatives of that phrase since the Trump administration came to power. But there are a lot of folks out there that are saying that a lot of those initiatives are still alive and well, or at least they should be. Joining us right now is Derek Lewis. He's the former president of PepsiCo's multicultural business and equity development in North America, and before that helped to run PepsiCo's North American business. Pleased to say he joins us in studio now. He's also the author of a new book called Surviving Plus Advance, Lessons on Living a Life Without Compromise. Derek, great to meet you.
Oh, great to meet you as well. Thank you for having me here today.
We've talked a lot here about how the public presence, if you will, of DEI and D&I has sort of been tamped down. But we've also talked with a lot of people that say it's evolved, that yes, they're not using those words, they're not using those phrases, but corporations are still committed to that, but maybe just in ways that are less likely to get them in trouble with certain people. Do you see that?
Yeah, I do see that. I see it's obviously a very chaotic time, and what you have in some cases are leadership or organizations are walking back without walking forward. And I think at the same time, while D&I can be modernized, it can be reframed, you know, for us to get to the next level as you think about the future and the generations behind us, there's this whole balancing act. So as you walk things back, you also need to keep walking things forward. And I think in terms of the business context, the minority cohort is still very important in all the businesses from a top line and bottom line perspective. Nobody is backing away from that. And so if you look at this triangle around consumer, I call it culture and community, those things all really connect well together. And so you can't really walk away from one and not, and you have to all stay together.
We introduced you with your last title that you had at PepsiCo, Multicultural Business and Equity Development. That was not a DEI program.
No, it was a new role.
Explain what that was, because there's so many. I hear DEI, D&I thrown around a lot by critics at programs that were never actually that. What was that?
It was really a comprehensive agenda, right? It really focused on really the greater good, right? So this was focused on the consumer. It was focused on the culture in the company and the associates there. It was focused on the community. And so it was taking all the best practices that we had throughout the company. We had a tremendous amount of best practices going on. I happened to be president of the South before this role, where we were really driving best-in-class implementation of these best practices. So therefore, the company asked me to sort of step in and, hey, let's try to facilitate so we can scale these initiatives in a more sort of consistent manner.
And by initiatives, these were investments.
These were absolutely investments.
Were you judged by what you brought in, or were you judged by, you know, profit loss? More
it was all the above. I mean, look, we're all, the business case is still there, right? We want to grow. It was all about growth, driving growth. Right? But to drive growth of that, you certainly have to look the part and have a culture that's supportive. And you also have to lift up the community where your associates work, eat, live, and play, right? So it all connects together. You can't look for something at the top line. The business case, by the way, Pepsi goes back to the 40s when they were the first to hire the first African-American sales force and first black interns in corporate America back in the 1940s. That was driven off the business case. Yes, certainly the moral implications also there were sound, but it started with the business case. And I think we're still here today. There's trillions of dollars across different cohort groups, right? And companies are going to stay focused on that. My point is, you still need to stay very committed on what you're doing inside the company and inside the community to certainly balance what you're doing with the consumer.
Multicultural business to me also sounds like when you're focused on the end market, your consumer, you need to look for growth. And that growth will be in underserved communities, and oftentimes that will be women, that will be people of color. Does that become harder to do, harder to execute when DEI is a dirty word, and in the front office, you can't talk about it, you can't have a program devoted to it or anything like that?
You know, I certainly didn't look at it that way. If you don't look at it in the lens of being a dirty word and look at it being the right thing to do, right? It is all about the business case. And so inherently, those consumers are very, very important for the top line and the bottom line, right? Inherently, looking like the market, or investing in areas that are underserved to help build those areas up, to give your associates satisfaction and also give you some loyalty, whatever business you're in. In this case, we're in the business of consumption. We want to have appeal and awareness with our top brands, right? And so it's the gift that keeps on giving. As you continue to lean in on associates, you continue to lean in on the community and the underserved spaces, it's going to be the gift that keeps on giving the top. I think you're seeing cases where people are pulling back from certain brands, certain companies, because they're not executing the triangle in the right way. And so when when that becomes instinctive, and that's what I tried to teach and our company tried to teach really, is making these things really instinctive where you didn't have to make it an add-on or bolt-on or mandate or something that was forced. It was something that was organic, it was instinctive. Again, companies had a long history that's going back to the 1940s, right? So a lot of that instinctive behavior still resonated throughout the company organization. So I think we're in today's times, we have to modernize some of the terminology, we have to modernize some of the practices, but we still have to evolve this triangle, I think, in ways that are going to be progressive for all and be all about the greater good. Very comprehensive, very collaborative, and most importantly, very compassionate, because right now I see compassion sort of falling dramatically in this, because you're dealing with people, and people are the greatest asset for all these organizations. And so when you're not compassionate about how you're walking things back, not walking things forward, not talking about the triangle, I think there's certainly going to be implications and consequences with that.
How do you teach that compassion in business school through case studies that are no longer relevant given the environment that we're in right now, in order to make sure that that comes into practice later on when those folks get into the executive suites?
I think for any business, and I look at this as a leader, I think you have to be successful, really 3 key pillars: results, relationships, and reputation, right? And so the ability to, it's all about performance, but relationships matter. The way you treat people, the way you work in teams, the way you collaborate, the way you build trust is very important on the relationship front, and that's with all cohorts, all for the greater good. And I think your reputation as a company, as an individual, as brands, matters to people, because now consumers, especially the younger consumers, are much more loyal to companies that embody causes that they believe in and things they believe in. So you have to really be future forward. There's a lot of looking back in the past on this, and there needs to be a lot more future looking in this. And I think once you get that strategic orientation, you'll find yourself doing the right instinctive things built for the long term, not the short term.
All right, that's a great place to leave it. Derek, a great conversation and great to meet you. Derek Lewis, a former executive at Pepsico, and he's the author of Survive Plus Advance, a book on lessons on living a life without compromise. All right, when we come back, we're going to set you up for what to watch over the next 24 hours. Stick with us. This is Bloomberg. All right, let's push ahead to what the markets are going to have their eye on over the next 24 hours, Scarlett. And it's a lot of economic data. And we start out, though, in Europe.
Yeah, and of course, they haven't gotten hit by tariffs just yet. So we'll see how that shakes out in months to come. But that gears us up for the 8:30 a.m. release of core PCE.
Yeah, right here in the United States. This is personal spending, personal incomes, and, of course, that inflation metric that is so important to Jay Powell.
Right. And the Fed had telegraphed that it's expecting 2.8%. The consensus, though, is for 2.7%. So it'll be interesting to see where it shakes out at.
Yeah, and we were talking with Veronica Clark at Citi. She says that kind of everything that gets baked into PCE, we kind of already know, so hopefully it shouldn't be a surprise.
You never know these days.
Yeah, you never know what could surprise the market. Maybe we do get a surprise out of some of that survey data, more of that at 10 a.m. Eastern.
And the consumer confidence levels in the United States have been falling because of all the uncertainty. This is the final read on Michigan, but we already heard from the conference board that confidence is at a 4-year low right now.
Absolutely, but it'll be interesting to see if that adds to that drumbeat, and we are going to get some more Fed speak. We heard from Raphael Bostic earlier this week. Well, guess what? You get to hear from him again tomorrow.
Oh, exciting. Can't wait.
We'll have all of that coverage right here on Bloomberg tomorrow. Thank you for watching.